Hello and welcome to Moneylife News and Views. I'm Debashis Basu. For the last several episodes, I've been talking about the Indian economy and the slowdown that's very visible to me and to a lot of independent people, but not so visible to a lot of people inside the market. They're still very, very bullish. Well, this time I'm going to put it all together and talk about the impact on the market, which I have already hinted a couple of times previously. As we all know, the Indian stock market has had a remarkable run for the past 4 years, recovering from the depths of despair it had sunk during COVID-19. The Nifty 50, which is the main index of the Indian stock market, closed at around 8,600 at the end of March 2020, and no one could have predicted what was going to happen next. The extent of rebound has been phenomenal. Despite a pandemic, the Russian invasion of Ukraine, Western sanctions, a slowdown in China and Europe, and even the loss of a parliamentary majority by India's ruling party led by an extremely popular leader, the market continued to rise. By the end of September 2024, the index had soared to about 25,810, a threefold increase and in just 4 years. Nifty's small cap index performed even more astoundingly, with a fivefold increase in 4 years. Now, all good things come to an end, or in the case of markets, come to a halt for a while. Over the past 6 weeks, Nifty 50 has dropped 9%, while the small cap index has fallen by 8%. Though experts downplay these declines, I'm not so sure. This could mark the beginning of a very long sluggish phase or even a prolonged downturn. Why am I saying this? I'm saying that it draws on a lot of things that I've mentioned in the last previous occasions, 3 or 4 of them, about how the economy is performing, and a variety of local and global factors all are combining together. And many of them are beyond the control of the Indian government. One key issue has just got added to the long list, and that is Donald Trump's sweeping victory in the US presidential elections. On November 6th, it became clear that Donald Trump would return to the White House. Strangely, the Indian market rallied strongly on that date, despite the fact that Trump's stated plans offer very little benefit to India. However, once the reality of his return set in, the market began a 7-day sell-off. Foreign investors, who tend to have a better grasp of macroeconomic issues than Indian investors, have been selling Indian stocks for some time. Trump's victory has only added fuel to the fire. While world leaders, investors, diplomats all wait to see what the unpredictable Mr. Trump would do, he has already made key appointments that align with the hard-edged Make America Great Again agenda. Among his key appointees is Elon Musk, who has been appointed to head the new Department of Government Efficiency. The writing on the wall is clear. Trump is in a tearing hurry to implement his campaign promises. It would be suicidal to assume that his promised actions would be tempered by realpolitik or would get bogged down in the Washington swamp or the deep state, as he calls it. Even if a part of Trumponomics, as it's being called, is implemented, it will hit the rest of the world like a tidal wave from which no major economy will be spared. Among Trump's planned actions are imposing tariffs of up to 60% on products from China and 10 to 20% on those from all the rest of the world. Any country that has a large trade surplus with America are being told that they're cheating us, he says. So Trump and his advisors are keen to fix these bilateral trade balances, the adverse trade balances. China, of course, is right up there, runs the biggest trade surplus with the US, followed by Mexico and Vietnam. They will be hit the most. But India is well up there on the hit list too. It is 11th in the list of countries that has a trade surplus with the US, just below Korea, Taiwan, and Italy. Large tariffs on China and Mexico. Now, Mexico is also used by China to direct exports to the US, seems certain. In response, China will cut its prices further and weaken its currency to protect its US exports. It will also redouble its efforts to capture more of the global south, where it has been remarkably successful in pushing out Western countries over the past few years. India has no strength to do any of this. We have a high cost and inefficient manufacturing base with a weak rupee, something our muscular government has not been able to fix. The next big problem for the world, and that comes from Trump's policies, is a stronger dollar. Trump is pushing hard to make American firms manufacture more in America through deregulation, cutting environmental regulation, and lowering energy costs. If he succeeds, the US will attract investments which will make the dollar stronger. From September 27, the dollar is up almost 6.5% and 3% since November 15th. Now, the impact of Trump's policies, such as tariffs and deportation of immigrants, will make tight labor markets in the US tighter still, and therefore the dollar will get stronger. Higher inflation will lead to higher interest rates, strengthening the dollar even more. It could well be that Trump team has a solution for all of this, but we will have to wait and see how these basic economic forces can be tamed. In any case, India is, as I said, just too weak in this whole game to be able to stand up and protect its own interests. A strong dollar makes imports more expensive for India and increases inflationary pressures for us. The timing could not have been worse. Troubles on the external front have come exactly at a time when domestic businesses are reporting a severe slowdown that is just not being taken seriously by the investors. Hindustan Lever, Nestle, Asian Paints, Britannia, Tata Consumers, cement companies, passenger car companies, banking giants, diversified companies like ITC, Reliance, microfinance companies are all struggling to grow. There's just not a single segment except the green energy segment, or maybe certain pockets of engineering and some other smaller manufacturing businesses, which are probably growing because they're tied to one of these two of these growth sectors. And of course, healthcare business is a perennial evergreen business which continues to grow. Now, rest of them are not growing at all. Jefferies, a foreign brokerage firm, recently lowered the FY25 earnings estimates for nearly 2/3 of Indian companies that it tracks, which have announced September quarter results. This is its steepest downgrade ratio since 2020. The reason, crystal clear to all of us, a cyclical slowdown in the economy, which I've been talking about for the last 3 episodes, and mine is a fortnightly episode. And yet, many Indian companies continue to be valued as if they are going to report double-digit growth year after year. The market sold off on all these concerns since the end of September. While it will try to go up when the selling pressure of FII is reduced, it would be a mistake to assume that all will be well. Trumponomics, poor growth, and high valuation certainly don't make for a bullish recipe for the Indian markets. If you liked what you heard, please do share, and thanks for watching. And also don't forget to subscribe. Thank you.